market opinion, Emkay in its recent India strategy note highlights that the Q1 FY25 earnings season was weak with a negative profit growth and muted top-line momentum across the board. But despite the rising share of negative surprises, the earnings forecast for the Nifty and the wider universe remains stable. So to discuss more on this report, we are joined by Seshadri Sen, the Head of Research and Strategist at Emkay Global, who joins in. Seshadri, hi, good morning, and thanks for joining in on CNBC TV18. It's very interesting because this was a bit of a sort of mixed earnings season that we had. But you tell us, what has the key takeaway been? And are there any sectors where you see both valuation as well as growth headroom now?
Thanks for hosting me, and pleasure to be back on the show. Yes, it was a mixed season, and the aggregate numbers, I think, hide a lot of interesting details. I think the key takeaway was that top line continues to be a challenge for most sectors. Top line growth, it was not particularly exciting. The numbers are a little skewed by oil and gas or energy, but even if you strip that out, there were some top line challenges for a lot of sectors. Margins, on the other hand, the aggregate margins looked a little poor, but if you strip out energy, then the rest of the sector actually did okay in terms of margins. So the trend that we've seen for the last few quarters, that margins are holding up earnings, but the top line is disappointing. That is what broadly continued. If you see the sectoral performance, I think one standout performer was staples and FMCG. That is where we saw, and you have to look at it in context. Staples and FMCG are not going to give you 30% earnings growth, but there was an acceleration in EPS growth from in staples from the fourth quarter to the first quarter. From I think 8% growth, it went up to 13% PAT growth. For very few sectors, actually, we saw the earnings growth actually accelerate over quarter on quarter, meaning that you didn't have a higher earnings growth in the first quarter than you had in the fourth quarter. But in general terms, this is relative, but in absolute terms, industrials continue to be one of the strongest earnings growth sectors at 27%. And durables and financials continue to perform. Durables includes autos, continue to perform strongly, though, vis-a-vis the first quarter, the numbers were a little soft. So that's the overall picture. I would say, the notable performances were from industrials and FMCG. Or staples.
Okay, so industrials and staples. Seshadri, thank you for joining in. So Q1 on expected lines was muted, and that's in the rear view mirror now. The question is on the earnings growth going forward. Now, Emkay recently concluded their conference where you had in-depth conversations with corporates across sectors. What is the feedback? Because so far, FY25, FY26 earnings estimates were unchanged. But is there a risk that this muted earnings growth will continue even in Q2, Q3, Q4, putting at risk FY25 or FY26 earnings estimates?
Yeah, let me answer that in two parts. Let's answer the second part first in terms of the risk to earnings. We did note in our report that there was no material change, and we don't just look at Nifty earnings. We look at a disaggregated analysis of about 350 top companies as to where their estimates are moving. And there also we found no cause for concern. And that is a much stronger because that's a disaggregated number. There's a law of large numbers that kicks in there. And we don't see a cause of concern that this quarter led to mass downgrades. What we did note, however, there was the pace of upgrades also has slowed. So there's stability in earnings forecasts. In terms of, so I don't think, in short answer, I don't think we need to worry about a major downgrade coming up. And that's a feature of the India's post-COVID rally that, typically you start with high earnings in April and we end up with a much lower number in the following March. That trend has been broken, and I don't see that trend coming back, at least in FY25. The feedback from our conference was very positive. Overall, we would say that despite some of the pressures that have come up in recent times, managements remain very confident, especially in the small and mid-cap manufacturing space. Managements continue to be confident of future growth on a multi-year basis, not just in the coming quarters. Two, are not changing their long-term plans. So the long-term plans include increasing capex. We've noted that even more conservative companies are continuing with their capex plans and are incurring new capex plans. Some of them are diversifying, entering new business areas, allied but new product segments. Some of them are still looking at M&A. The cash-rich ones are still looking at M&A, and none of those plans seem to have changed in the last 6-8 months, and that is something that we take a lot of confidence from. The other notable feature from the conference is that, as far as consumption is concerned, premium and urban consumption is slowing down, while rural and mass consumption is picking up. This is a reversal of a 4-year trend. As you may know, the post-COVID market has seen rural and mass consumption do badly, while premium and urban has done well. That seems to be reversing. It's too early to say whether that's a long-term trend or a medium-term trend, but something that we are keeping an eye out on, because that will mean a lot of implications on which stocks investors should hold.
Okay, so slowing consumption at the premium end remains a bit of a concern for you. But mass consumption recovery is a significant tailwind. I want to delve a little deeper into that. When you talk about mass consumption recovery, what is it exactly? Because now we are seeing, a lot more urbanization as well. So perhaps stocks like, say, something like a Zomato, Nykaa sitting at a fresh 52-week high today. Then, of course, you have, stocks like Ola, etc., which are doing very well. Are these niche consumption stories something that you like, or would you want to stick to the traditional consumption guys, whether it's, traditional auto sector or FMCG?
A mixture of both. So let me talk about traditional. So we prefer, say, two-wheelers to passenger vehicles. We prefer staples to discretionary consumption. Right, though that is the way we would play. Within the retail space, we would look for particular mass consumption, lower end retail chains rather than the premium retail chains. Especially as some of those names may have underperformed in the last 3-4 years. So that's at the traditional end. As far as the new trends are concerned, yes, we are very excited about that area overall. But one will have to pick and choose. One will have to look at which companies are genuinely, innovative, making an impact, and are demonstrating ability to show long-term growth, versus some of the companies which, maybe sort of showing a short-term growth, etc. But there's a risk that penetration will soon die. It's a tricky area. It's high risk reward. If you get it right, then there is, a really serious long-term upsides to be made. But as we've seen, if you get it wrong, then some of these companies can, valuations are not really comfortable, and there is no underlying profitability. So, sorry, that's a sort of not a direct answer, but one has to be careful of that space because it's high risk reward.
Fair enough. So, if you had to construct your portfolio today, Seshadri, how would you do it? What would the constituents be?
So we are, we've published a lot on this. So our views are very, very clear. We are underweight on financials because we think that financials, the de-rating that we've seen post-COVID is still yet to be done. The sector is entering a new low growth phase, and valuations are yet to adjust. So we are underweight financials. We are overweight at the moment. We are overweight staples and IT. We did that, post-elections because we found valuations to be attractive. Now, some of the valuation comfort has gone, but we are seeing, an upgrade cycle start to kick in there. So we wait and watch that space, but we continue to retain our overweight there. We are overweight durables, which includes autos. Now, one has to be selective, but overall as a sector, we think that the auto cycle, CVs we remain confident of, two-wheelers we remain confident of, and the auto cycle will continue for some time, and we will continue to play that. One may have to do some nifty stock picking there, but that sector we continue to like. Industrials, from a fundamentals perspective, is one of our favorite sectors. We think from a 3 to 5 year perspective, that is where we will see the maximum growth. But we thought valuations ran well ahead of themselves, and therefore there is some valuation sanity which needs to return before one can dive into that sector. Having said that, there are plenty of it's a really large sector with lots of small and mid cap stocks. So as long as valuations remain, we are not out of whack, there is still ideas to be harvested there. But as a sector, we'd be a little cautious.
Okay, well, we will leave it at that. Thanks a lot, Seshadri, for joining in and speaking to us on CNBC TV18. Appreciate your time here and speaking to us about your report as well. That's MK with their latest India strategy note and the way forward. Let's step into a quick break. On the other side,